Hey time travelers, this is Nyle here to give you an update of the market post-Trump election based off the charts. Pretty sure I nailed that. All right, everybody, let's get into this information that a lot of people were shocked and surprised that the market was rallying so positive when the futures market was down 5% the night of the election because everybody was freaking out that we were going to have a surprise leader when all the polls said that Clinton was going to win it, and guess who didn't win it? It was Clinton. And so Trump moved in, and the positive reaction from the market, we had this huge market rally, and people said, how is this happening? It's all because of Trump, etc., etc. But when we look at the data, like this chart, we see that 68.8% of the time, the market is higher after a presidential election from the election night to inauguration. So maybe it's not that crazy anomalous of an activity. It's something that happens the majority of the time. Now, the average positive return of the market during that segment from the election to the inauguration is 1%. And the median, so if you remove a lot of the highs and the lows, maybe that 19.9% drop that Obama faced in 2008, we get a 3% return during that same time period. So not that different. However, we are seeing a lot different of how people are investing their money. Look at this chart. We're seeing $1.8 trillion that have fallen out of the active money managers' hands in the past 8 years. Active money managers, like being those guys who are running the mutual funds of the world. Monies are fleeing them in the high fee environment and going into index, ETF, passive investing, where there's a lot less fees, but you're buying the whole market together. The good part is you're buying the whole market, you're getting a lot of the good stuff, you're not fighting these fluctuations and these knee-jerk reactions and volatility in the market. Bad news is you're buying the whole market, you're getting the crappy positions as well. Needless to say, a lot of monies are changing, and the sentiment of how people invest is completely different than it was, let's say, 8 years ago. And we're also getting new politics. Is there a correlation there? We don't know, but a lot of people are saying that the market is maybe overvalued at this time. Maybe has a lot to do with the indexing, where people are buying the whole market. We see price to earning ratios at the 18.1% range. So how much are these stocks earning, and where's their price point? Put them together, you get this ratio number, but really it's kind of right in the middle of what's typical for a market that might perform in the positive range. So we think that there is a lot more positive upside to this equities market based on this chart is a great example of that. But let's look at the total debt. This could be a problem. When we look at the total debt pre-Obama, post-Obama, we are at the point where there is more public debt than the top companies in the S&P 500. That's an amazing stat that is off the charts. And then we look at the student loan debt, and this correlates to the type of jobs that we're taking. You see the student loan debt is almost past $1 billion, probably just past $1 billion right now as you're watching it, has just passed a tremendous amount of levels. And then look at this, the jobs that people are getting, the waiters and bartenders are up almost 500 points, 500% since the past 2 years alone, where manufacturing is down. Maybe that has to do with all the student loan debt and what we're doing with these graduate jobs and degrees and moving into the waiters and bartenders side of the category. We don't know. Let me know what you think about what we know together, and that way we can do this as a community. Like, subscribe, follow us on Facebook, Twitter, Instagram, right here on YouTube. Otherwise, we'll catch you in the future. Remember that decisions today change tomorrow's. Thanks a lot. I'm Nyle, and thanks, Nick. You did great.